Right now, Lithium Americas Corp., trading under the ticker LAC on the NYSE, is sitting at a live price of $5.01 as of Wednesday, April 29, 2026 at 5:45 a.m. Eastern Time. That represents a drop of 4.57% during the current intraday session, continuing a stretch of volatility that has become the calling card for this Nevada-focused miner. While a 5% swing might look like a red flag on a standard individual brokerage account, there is a much deeper story happening here that most retail investors are missing. The market is currently pricing this stock as if it is a struggling mining startup, but the reality is that Lithium Americas is essentially a government-backed infrastructure project disguised as a speculative mining play. While the price action is choppy, the structural de-risking we have seen over the last few months is staggering. If you look at the $2.26 billion loan from the Department of Energy or the massive capital injection from General Motors, you start to see that the gap between the market's perceived risk and the actual project security is wider than it has ever been. Most people looking at the Lithium Americas stock price right now see a company that is underperforming the broader market, especially when compared to the high-flying tech sectors. The expectation is that because lithium prices bottomed out and recovered, this stock should be soaring. The reality is that Lithium Americas is being held back by a very specific form of execution tension. Investors are exhausted by the timeline. We are looking at a project where mechanical completion of Phase 1 at Thacker Pass isn't expected until late 2027. That creates a massive vacuum where short-term traders exit the position to find faster gains elsewhere, like in the Nvidia stock or Tesla stock rallies. But this is exactly where the smart money separates itself. While the crowd is chasing immediate returns on the best investing sites, the institutional activity in Lithium Americas shows a quiet accumulation. Recent 13F filings from the end of April 2026 reveal that while some smaller funds are washing out, larger players like Ping Capital and PFG Investments have been increasing their stakes. They aren't looking at today's intraday drop. They are looking at a domestic lithium supply chain that the US government has literally deemed too important to fail. The trading volume we are seeing today, which is hovering around 96,000 shares early in the session, shows a market that is waiting for a catalyst. If you're using the Fidelity mobile app or the Robinhood app to track your positions, you've likely seen the 52-week range for this stock move between a low of $2.47 and a high of $10.52. We are currently trading right in the middle of that range. This suggests that the easy money from the initial bounce off the lows has been made, and now we're in the grind phase. This is where the narrative shifts from will they build it to how efficiently will they build it. The company just confirmed that construction at Thacker Pass is hitting peak activity in 2026 with about 1,800 workers expected on site by the end of the year. That is a massive operational scale-up that carries significant cost risks, especially with the inflationary pressures we have seen in the mining sector. One of the biggest questions I get from people using SoFi Invest or Interactive Brokers is why the stock doesn't move in lockstep with lithium carbonate prices anymore. The answer lies in the financing structure. Lithium Americas has been using at-the-market equity programs to fund its share of the development, which has led to significant dilution. In early 2026, they completed a program that sold over 68 million shares. When a company issues that much paper, it creates a ceiling on the stock price, because every time the price tries to rally, there is a fresh supply of shares hitting the market. However, that dilution is the price investors pay for the project being fully funded. They now have the cash, the government loans, and the GM offtake agreement in place. The common belief is that dilution is always bad, but in this case, it was the necessary evil to prevent the company from going under during the lithium price collapse of 2025. Now that the capital is secured, the focus shifts entirely to the 40,000 tons of battery-quality lithium carbonate they plan to produce annually. Comment below how many shares of Lithium Americas you currently hold, or are you waiting for it to dip back below the $5 mark before you buy in? It's interesting to see how many people are using a robo-advisor like the SoFi robo-advisor or Schwab Intelligent Portfolios to manage these kinds of cyclical plays versus those doing self-investing on a Robinhood or Fidelity trading platform. When we look at the business model, Lithium Americas is essentially a toll booth for the North American EV revolution. They own 100% of the Thacker Pass project in Nevada, which is the largest known lithium resource in the United States. Their strategy is simple: produce lithium domestically to help the U.S. reduce its reliance on Chinese supply chains. This makes them a strategic asset rather than just a commodity producer. This is why General Motors didn't just sign a contract to buy the lithium. They actually invested hundreds of millions of dollars into the company and have rights to up to 100% of the Phase 1 production for 20 years. If you are holding this in a Fidelity IRA or a long-term individual brokerage account, you aren't betting on a mining company, you're betting on a GM supply chain partnership. The disconnect between expectation and reality is most visible in the unperforming label that many mainstream analysts use to describe the company. Yes, the company is losing money today because they're building a multi-billion-dollar mine. That is the reality. But the expectation that they should be profitable now is fundamentally flawed. If you wait for the company to be profitable, the stock won't be trading at $5. It will be trading based on its projected annual EBITDA, which could be in the hundreds of millions once phase 1 is fully operational. The current market cap of roughly $1.7 billion seems high for a company with no revenue, until you realize that the net present value of the project is estimated to be significantly higher. Looking toward the future, the catalysts are all about construction milestones. We're watching for the next Department of Energy loan drawdowns, which act as a seal of approval on the construction progress. Any delay in the late 2027 mechanical completion date will be treated harshly by the market, potentially sending the stock back toward that 52-week low. On the flip side, if they can show that they are staying on budget despite the 10 to 15% cost inflation seen across the industry, we could see a massive re-rating. Institutional investors on the Interactive Brokers platform or using Fidelity Wealth Management Services are looking for stability. They want to see that 1,800-person workforce is hitting its marks without safety incidents or regulatory hurdles. The risk profile here is heavily weighted toward the macro environment. If the U.S. administration shifts its stance on EV subsidies, or if the transition to electric vehicles slows down significantly, the demand for the 40,000 tons of lithium from Thacker Pass could be questioned. However, with the rise of stationary energy storage for AI data centers, a sector that is growing even faster than EVs, the demand floor for lithium appears to be much higher than it was 5 years ago. Even Apple stock and other big tech names are indirectly tied to this as they look to secure battery materials for their own hardware and data infrastructure. To wrap this all up, the story of Lithium Americas is one of extreme patience versus extreme potential. The expectation is that a government-backed project in the hottest sector on Earth should be a slam dunk for your investment portfolio. The reality is that the path to production is long, expensive, and filled with dilution that tests the resolve of even the most seasoned investors. Today's price of $5.01 reflects that tension. The market is giving you a discount because of the wait time, but that discount disappears the moment the first ton of lithium is processed. We have seen a shift from a speculative maybe to a funded when, and in the world of online investing, that is a massive distinction. Whether you're using the Robinhood Investments app for quick trades or holding for the long haul in a Fidelity brokerage account, the core insight remains the same. Lithium Americas is a play on American industrial policy, not just a mineral in the ground. The gap between the current intraday volatility and the long-term strategic value of Thacker Pass is where the opportunity lies, provided you have the stomach for the swings. Keep a close eye on those construction updates throughout 2026, because that is where the real value will be built, one foundation pour at a time. Disclaimer, this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.